Hey everybody, and welcome back to my channel. Today I'm talking to you from the US of A. I traveled here today, a very long flight, about 17, 18 hours in total to get to my room here. But I wanted to give this out to you, and I thought I'll just do a quick recording and upload it for you guys. So today the question is this, and I've been asked this before, and the topic is, why do majority of the strategies fail? You find a strategy that you really like, you find something that you resonate with, and suddenly it works for a short amount of time, and then suddenly it stops working. And not only that, maybe you have developed something yourself. You've picked up a strategy and kind of retweaked it, re-engineered it so that it resonates with you. You've done the amount of time for back testing, you've done a little bit of forward testing, but then a time comes in where it falls apart, and then you're scratching your head what to do. You panic and you start making all these wrong decisions. And the question is, why did this happen? The answer to that is very simple. Typically what happens is that whenever we have a strategy that we sort of developed and we have back tested, you have back tested a strategy based around a certain set of boundary conditions, a certain set of rules, that each and every trade follows a certain pattern of your decision making on when you should take a trade and when you should stay out of a trade, right? And all of those small decisions over a large sample size has given you the equity curve, or it has given you the results that it has, but based on every decision that you took along the way, right? If any one of the decisions changed, then the whole dynamics moving forward would have changed. So think of it like Back to the Future, right? So you are in a timeline and you go back in time and you change something over here, and then you create another timeline. That was the premise of that movie. But it is very true, so to speak, for our training world as well. When you go live after back testing your strategies, or when you go live after even forward testing some of the more successful strategies, and why it stops is because your behavior or your approach towards that strategy changes. And I can guarantee you this without an ounce of doubt. If you have a strategy that you've back tested, the reason why it fails is because you started tweaking that strategy in live markets. And the minute you tweak any variable in your strategy, it is not what you had tested in the past. It has now become a completely new strategy, which will have its own completely different path, a different equity curve, and they might resonate together or might not resonate, but there is no connection between the two, right? And this is where most traders fail. They fail to comply with their own boundary conditions or their own decision making when live markets is, because of the emotional involvement in the trade, when to get involved, when to stay out. So for example, if let's say a mechanical approach or your strategy when you back tested gave you 5 or 6 losses, right? But it's back testing. Those 5 or 6 losses don't really hurt you. They don't resonate with you. They don't bring you that heaviness that live trading will. But once you go into live markets with a prop firm account and with your own capital, and you start seeing that loss 1, loss 2, loss 3, loss 4, loss 5, loss 6. Now the question to you is, after 6 losses, your back tested strategy, the 7th one was a winner. And that because of that winner, the consequent pattern or output of that strategy took you to equity curve that you have. But would you take that 7th trade even though it met your requirements in live market? That is the dilemma, right? Majority of us, including myself, after 6 losses in a row, if I was manually trading, which is looking at the markets and physically pressing a button to get involved in a trade, I would probably shy away. Even though that trade could have been the winner, that trade could have been the difference between going positive and staying in the drawdown, that trade could have set my entire direction of the equity curve completely different. And this is the reason why I like to stay away from manual trading, because one element that nobody can backtest and nobody can forward test and there is no way you can consistently draw a pattern is your emotions. In live markets, it depends on how are you feeling that day. It could be the same situation given a different day and your different mindset coming into that day, you will approach that same trade differently, right? So maybe you are in a pretty good mindset, you just worked out, you're feeling full of energy, your test and your hormones are really pumping and you want to get involved, versus the same trade, you're feeling low, you're feeling lethargic, you're burnt out from partying last night, maybe you had a fight with your wife or your better half, and you're just not in the game. Now, if you're not in the game, I would not even recommend to get onto your charts. But then again, the same opportunity that presented itself, now you would probably make mistakes or not get involved. And that is why I stay away from manual trading. I want to keep myself away as much as I can from my trading and want to keep it as mechanical as I can. And what I mean by mechanical is that there is absolutely no emotional or discretionary decision making. I don't have a gut feel. Of course, I have a gut feel. I know what might happen, might not happen, and there is a certain element of it, but I don't dwell on it, or I do not use it as a decision making factor at all. I have a certain series of rules. If this happens, A happens, B happens, C happens, D happens, I execute. I execute no matter what happens. I execute like a robot. I execute even if I have 20 losses. Because in the back testing and the forward testing I've done is that over a large sample size, I will always come out on the top, right? And this removes all anxiety. It removes all stress from the trading, because I know that I have that mechanical edge. And very, very quickly, let's pivot to what that mechanical edge is and what my FFX strategy is. Again, very simple. All I like to do is look at a strong momentum 15-minute candle, right, which inherently has a 1-minute trend in it. That 1-minute trend has established itself with a lower high, lower low, lower high, lower low. And all I'm trying to do is get involved on the wick of the second 15-minute candle as early as possible to catch that trend. So what I mean by that is, if you look at any given chart, right? So this is a 15-minute chart on Euro USD, 50, and there are trends. This is a trend, and there are ranges, trend and a trend, range, trend, range, and this is how markets flow, right? So if and you can test this on your own. This is 30th January 2026. On Euro USD during London Open, there was a nice trend. And in this trend, what do you notice? If it's a good, healthy textbook trend, you will have large momentum candles, you will have large momentum candles, you will have large momentum candles in the direction where the trend is, and you will have nice solid wicks. And these wicks is where the whole, let's say, secret is. And not even a secret, but this is where the game is being played, right? So this on the right, left-hand side is the 1-minute chart, which represents the 15-minute over here. And let's quickly look into this. What I do is I will highlight with a box. Let me show you here as such. And then I will, within this box, and this is the only box that I look at, I don't look anywhere else. First of all, I look at, has it established a trend? For me, this was the last high, this is the last low, and then this is the internal trend, right? And then you have a trend break. So this is the first indication that the internal trend is broken. This is the lower high. There's another break right here. So the internal trend is broken, and then the major trend, the external trend is over here. Once this goes, then the major trend goes, right? So for me, this is what's happening. You have the box here. The first 15-minute candle finishes at about right there. Yeah, at the 16-minute mark. This is the start of the new candle. And if I get an entry in this area, then I want to get involved and ride this trend. What do my entry patterns involve? Very, very simple. I look at if there is a zone, if it is mitigating a zone, if there is any sort of liquidity that is taken, a strong high, a strong low, or a weak high or a weak low, depending on how the market is moving. And then I put a stop order. If all of these, of all three criteria is met, I enter. and there's nothing more to it. So if I didn't get a trade in this, so be it. I move on, because markets will stay tomorrow, day after, long after I hit high. Markets will stay, and they move exactly the same way. They have candlesticks, and these candlesticks have wicks, and they trend. And if they are trending, then you can catch that trend no matter what, right? Don't let anybody else trick you into saying that you need lagging indicators, you need the 1,000 different pieces of information and volume and blah blah blah. You don't need all of that. In retail trading, price action is king, right? And the quicker you get involved, the quicker you'll make money, and the quicker you can get out of the market. You don't want to stay in there exposing capital for a long period of time. So look at this blue box right here, right? So this is my candle that I'm looking at. It's a strong 15-minute candle which has broken the previous lows, yeah, which means that it has broken the actual external trend. It is going downwards, creating internal trend as well, which is in alignment with the external trend. So everything is bearish. Why will I not get involved? Next thing, what do I look at? I want to catch this wick right here. So if you look at the 15-minute chart, this wick right here, this is what I want to catch so I can ride this trend, right? Very simple. What do I look at? I look at mitigations. Is there a mitigation? There is a larger mitigation. There is a buy to sell thing over here. You can say yes, it is a mitigation. If you wanted to refine it a little bit, the top part, refine it a little bit more, this part, maybe then if it is part of your rules, this will not be a trade that you get involved in. Is there a liquidation? Yes. This point here is the one that is a strong high, because this point was responsible for breaking this low. So if it has broken a structural point in the direction that I want to trend in, this is a strong high. What does that mean? That means there is tons of liquidity sitting at the top of this, right? And that is where I want to get involved after that liquidity is taken, that sweep happens, right? So once the sweep happens, you can very easily enter a stop order at the low of this candle. You can place a high at the top of there. You can place a high at this candle right here, or you can place a high at the top of this wick, which will give you about 2.1 pip stop loss, fairly tight. Depending on your broker and your spreads, you might want to keep that or not. You can increase it by half a pip or 1 pip, like that. And the premise is this, that once, the premise is this, that once the low of this candle breaks, which means on the lower time frames, right, the seconds time frame, the structure has shifted. Once the structure has shifted, I want to get involved the earliest possible way, the earliest possible time that I can, to take advantage of a small stop loss and a larger run. So this one, very easily, if I were to keep it the whole thing, if I look at over here, took us where? It's an 8.5 hour one, right? How easy was that, right? How simple was that? And you can easily go this, you can highlight this candle and check this trade, you can highlight this momentum. Now this is pre-London, you can highlight that. So very quickly, let's do this. Highlight that candle. I want to get involved in this wick right here, this wick right here. So what do? I look at to see if there is any mitigation. You could probably argue that yes, this is a pullback right there. This inside bar is a pullback right there. It is a mitigation. Is there any liquidity taken, a fractal liquidity? You can argue that this low was the one that broke this high over here. So there is a fractal weak liquidity over here that was taken. And then depending on your factors, you could put a stop order here. You could put the stop loss right there, or you can cover the zone. And then it gave you a pretty nice, neat little 3.5 hour run. Yeah, there's no rocket science to this. There was no gut play. There was no intuition. There's no, I know how to read a market. It's just mechanical rules. These are my rules. I stick by it. And I know they deliver because I've done the hard work. And again, coming back to the original questions, why do majority of the traders fail? Why do majority of the strategies fail? And the answer to that is that strategies don't fail. Traders fail in executing how those strategies need to be carried out or need to be executed. The minute you change anything in that strategy, it is a brand new strategy that you're working with. It is no longer what you were familiar with when you were doing the backtesting. So follow your process. Stop changing things in live markets. If you have boundary conditions, obey them like the commandments, and then the market will give you your returns. Thank you, guys. Have a good one. Cheers.